is a day to review why is Bitcoin moving the way it is. Well, if you know anything about trading the VEX, which I obviously talk about frequently on this channel, then you know that Bitcoin, just like any asset, does two things, right? The returns of the asset move away from the mean, and the returns of the asset mean revert. That's really all that happens. Assets move away from the mean, and assets mean revert. How can you tell when it's doing those things? Well, if you use the alpha trading indicators, you can see exactly where the mean of returns is. And you can see when the asset, and by that I mean the returns, move away from the mean of returns, and when they are reverting to the mean of returns. What happens with the price is the price simply follows. And does the price follow on every single candle? Or can there be a candle or two or three that are out of step? The answer is yes, there can be a candle or two or three that are out of step. However, when you chunk down to lower time frames, you will usually see why that's happening. Because on the lower time frames where the changes are happening, you can see things that are happening faster than on a higher time frame. And so it's entirely possible on any time frame for the asset to sometimes appear to be out of step in terms of the price following the returns. However, after 1, 2, or very rarely 3 candles, you'll see the asset follow what it normally does, which is that the price action follows the returns. And that's why we can use things like the returns oscillator or the alpha laser returns indicator, either one of those, to actually see what the returns are doing. If they're positive or negative, if they're sloping up or down, if they're moving sideways. And that's why we can use volatility, which is the standard deviation of returns, and the correlation to the price action, right? The volatility's correlation to the price action. Of the probability of whether or not the price action is set to move up, down, or sideways. After all, why wouldn't you use leading information like that offered by the alpha trading indicators in order to trade with the same information that's used by the smart money? Because the smart money literally controls the market. They literally move the market. By smart money, I mean the HFT firms, the big quant shops, and other financial institutions and companies that know what the leading information is, and they use it to trade. And the HFT firms and quant shops alone have servers that run millions of trades per second. And they have many such servers, which is why there are so many millions of trades per second across the markets. And when they run so many trades per second, they're able to control the markets, both in terms of its direction and in terms of its overall performance. So, again, if you know this information, why would you not want to use it? When you specifically know that the leading information quite verifiably controls the markets that you're trading. Not just the overall market as a general concept, but each and every asset on it. How do they do that? Well, they do that by running orders that are relatively small in position size and that last on average 0.2 seconds or less. And in so doing, they are able to run so many trades and take profits so very quickly, because remember, you don't need to wait for the asset to move a percent to be in profit or a half a percent or anything, right? They just need the most basic tiny little movement and there you go, because their position is so big relative to other traders that they are actually doing just fine taking small little profits on trades. Millions of trades per second. Right? So they don't have a problem targeting certain areas, which they do through their algorithms, right? They're robots, right? Little software bots which run these algorithms, and those algorithms target using the same exact leading information that we run at Alpha Trading. Now, sure, could you say, well, your VRE chart only has the 4-hour and the daily and the weekly and the monthly. You don't have like the 1 minute on there, etc. Guess what? They also use similar time frames that we look at, and they of course have programmed into their bots lower time frame, and we could just as easily set those on our charts. The difference is you're not likely to run millions of trades per second by hand, so there's really no point in running trades where you're looking at time frame levels that really don't apply to you. Could you look at them with our tools? Absolutely. Would it optimize your performance? Probably not so much. Does that mean you shouldn't try and experiment with it? No, by all means experiment with it. Look at lower time frames. Feel free to set levels as low as you like, as low as the software will let you go. I think on TradingView it's like 1 second is the lowest, but that's fine, right? So yes, HFT bots are running trades using the same exact information we're using. They're just trading on lower time frames because they have the position size to move the orders, or to move rather the market, to chase their orders to be executed up or down, whichever way they want. Right? And as soon as they run that order and it's executed, they take profit or they close their position with a minor loss. Right? But generally speaking, because of the size of their order compared to the overall market, unless they happen to run an order at the exact same time as a competitor who also has a significant position size, usually if they're running it without major competition from another significant whale, in that instance, they'll get their order filled. The price will follow the returns that they've targeted, and within 0.2 seconds or less, they'll close that position. And again, a major position on an asset like Bitcoin on any given exchange is a relatively small amount of money for market makers at HFT firms and other places. And if you think they're not trading Bitcoin, well, guess what? They are trading Bitcoin at HFT firms and algo shops. They absolutely have been doing that for a long time, whether they admit it or not, whether it's on the books or off the books. Right? It Doesn't really matter. It's clear, it's evident. They've been using Bitcoin as a wonderful, volatile asset to make huge gains, as well as obviously the traditional assets that they trade. And they don't just trade Bitcoin, right? They trade every crypto, all in proportion. It's very easy, right, for the bot to trade a basket of assets, say the top 2,000 or 10,000 assets, right? Just run little algorithms that trade those assets all in proportion to their overall assets market cap or any other factor they use to decide on the proportion. So it's not difficult for a bot to run those orders. Even if there's 10,000 assets that an HFT firm is trading just in crypto, out of the millions of tokens they could be trading. Right? And, that is not going to be a problem when they're running millions of trades per second, right? 10,000 goes into a million, a good 100 times, right? So they could fill 10,000 asset orders across the board 100 times in a second. Very easy at the low end of their servers, right? Their servers are capable of doing far more than a million orders per second. That's just the basic entry-level HFT server. Right? You can build one at home that's technically capable of doing that, a million orders per second. You may not have the speed required to do that, the internet speed. You may not have the position size available to do that. But technically speaking, if you want to learn how to build HFT bots, you pretty much start at a million trades per second, right? Or at the very least, hundreds of thousands of trades per second, and quickly ramp up from there. So keep in mind, the assets being traded by the HFT firms are being traded in order to benefit them by using the VAPs on very low time frames. And that is why the asset is moving the way that it is, and always will, right? Until some magic thing comes along, or something better than math shows up, that's how they're going to do it. Will there be maybe better math that show up to determine better how to run the trades? Maybe. However, so far, nothing better has shown up yet. Are there different distribution models you could use? Yes, there's a few. Arch, could use a number of them actually. But Laplace and Normal at the moment are the market leaders in terms of distribution models, because they are the ones that deliver consistently profitable returns and are relatively easy to maintain order systems. Okay, that's it. Happy trading.